Today, we are just going to touch upon the hits and misses related to the HNI, which were discussed in today's budget. Largely, this has been overwhelming, where everybody has been talking about the surcharge that's been applicable to HNIs. As we all know that the highest applicable surcharge for any individual earning more than 5 crore is 37%, which brings their effective tax rate to as high as 42.74%. Now, realizing that there has been a flight of capital and movement of HNIs out of the country, this has now been rationalized, though not back to the original slab rates, surcharge rates, but gradually, and that has been promised that they would reduce these rates gradually. So now the surcharge applicable to HNI has been restricted to 25%. Accordingly, the effective tax rate is now back to 39%, restricted to 39%. However, one point that we should be mindful of that these provisions, relaxation is applicable only for people opting for the new tax regime, which I believe that now there's good incentive for people to opt for the new tax regime. So that's a very welcome move. One thing to be mindful of is for the trust structures. Of late we have been seeing that there have been so many promoters and individuals who've been setting up trust structures in India, and in quite a few cases they are discretionary trust. Again, these discretionary trusts, there's any income other than the capital gains, they are still subject to tax at MMR. The unfortunate part is that the surcharge of 37% that has been reduced to 25% has not been abolished. What it means is that the tax law still retains the rate of 37% surcharge for people opting for the old regime, and which brings a dilemma that whether the MMR rate, which is applicable to these trusts, whether that continues to 42.74% or that also would be brought down to 39%. One another aspect that where the FM has tried to plug in the loophole or try to restrict the benefit for the HNI category is related to the capital gains exemption on acquiring new residential house property. This is a beneficial provision which is applicable to everyone. However, there was no cap on such benefit to be availed. And typically in the past, we have seen that, promoters and startup entrepreneurs, and in fact, a lot of management guys who used to hold ESOPs, at the time of exit and when, they make big capital gains, they used to invest those gains into acquiring luxurious residential properties, and they used to avail this benefit. Now with this amendment, that benefits are restricted to 10 crore, that is 100 million. So there is going to be a little bit of a setback for the real estate projects with luxury setups. Another aspect which one will have to be mindful post this budget is the applicability of tax collection at source on the typical remittances done under LRS. While they have not touched the TCS provision related to remittance for any education or medical, they have increased this rate to as high as 20% for tourist payments, and also for any other residual payment, which will cover any sort of investments which an individual would make. Be mindful that this would also be applicable for any sort of investments that would be going to the gift city, because any payment made towards gift city, that has to be done under LRS. So now one will have to shell 20% extra while making these remittances. While this money will be available back as a credit when you file your income tax returns, but this will have a definite cash flow implication. So let's see if these provisions continue the way they are, or we get some relief in the final budget before it has been passed by the Parliament.